Governments claim they work for your financial freedom, or at least, that's what they say. They talk about stability, growth, and opportunity. But if you look a little closer at history, you start to see a much darker face behind these pleasant words. The reality is this: for centuries, governments have used hidden financial tricks to protect their own power and wealth. And while doing so, they have usually left ordinary people poorer. And here's the most interesting part: these tricks are not new. Only the packaging and the names have changed. The goal has always been the same: move wealth upward and keep most people dependent on the system. Let's start with the oldest and simplest trick of all: inflation. When a government begins spending more than it collects in taxes, it has two options. It can step forward, tell the truth honestly, and directly tax its citizens, which is politically very risky, or it can quietly devalue the currency. In other words, it can reduce the purchasing power of every coin and banknote in your pocket without you noticing. Ancient Rome used this method professionally. In the 3rd century AD, emperors struggling with rising military expenses began reducing the silver content of the denarius. What was once a coin made almost entirely of silver gradually turned into one made mostly of copper, coated with only a thin layer of silver. Officially, nothing had changed, but everyone holding that money paid the price. Inflation exploded, savings evaporated, and wages stagnated. This was a silent tax imposed on the public. A method still used today, only now central banks have replaced imperial mints. If we move to the Middle Ages, we see a different version of the same game: forced loans. Kings in England, France, and Spain pressured wealthy merchants and guilds to lend money to the crown. These loans were not voluntary. Refusal meant fines, confiscation of property, or worse, sometimes repayment with interest was promised. But repayment was often delayed, paid back in devalued currency, or never made at all. While kings kept their wars and palaces running, merchants had no real choice. The trick was obvious: presenting coercion as duty and patriotism, and it worked for centuries. By the 17th century, the financial system itself had become the trick. When the Bank of England was founded in 1694, it was not an act of charity. The government needed money to finance its war with France. Wealthy investors bought government bonds, and in return, the state guaranteed interest payments funded by taxes. On paper, it looked fair. But what mattered was who paid those taxes. The public paid them through taxes on salt, beer, and cloth. The wealthy earned safe interest, while the poor financed it. This was a wealth transfer mechanism disguised as national finance, and it laid the foundation for a model still used today. In the modern era, these tricks are everywhere. Think about budget deficits. Governments issue bonds, which are bought by banks, investors, and foreign funds. Politicians tell the public the money is for infrastructure, jobs, and social programs. But most of it goes to defense contractors, corporate subsidies, and bailout packages. When repayment time comes, the bill is handed to the public. Taxes rise, money is printed, or social spending is cut. The debt looks like it belongs to the people, but the profits go to bond. Remember the 2008 crisis? Banks took reckless risks, and the system nearly collapsed. Who paid the price? Taxpayers. Who won? The same banks, now even larger. The trick was simple. Profits were privatized, losses were socialized, and the public was told this was necessary to save the system. Even pension systems are a form of deception. People pay into government-run systems for decades, believing the money will be there when they retire. In reality, that money is often not saved at all. It is spent immediately. The promise is that future taxpayers will cover the cost. The system works until the population ages. Then benefits are cut, retirement ages rise, or payments are quietly eroded through inflation. At every level, the same pattern appears. Inflation is called growth. Debt is called investment. Bailouts are called stability. Cuts are called reform. Language hides reality. Wealth is quietly moved upward. In recent years, the tricks have become even more complex. Terms like quantitative easing appeared. Trillions were created out of thin air. asset prices soared, but those assets were already owned by the wealthy. For the average person, life simply became more expensive, and the same thing is still happening today. Inflation eats away at savings. Debt keeps growing. Bailouts remain the first response to crisis. Complex laws and budgets hide the truth. Because you can't resist what you can't see, the lesson of history is simple. These tricks always return, only the names change, and the greatest trick of all is convincing people that this is natural. That's why financial education is a form of resistance. Knowing history is a defense. Look beyond the headlines. Ask who profits. Never assume the system works for you, because systems don't exist to protect you, they exist to protect themselves. The same financial tricks that destroyed Rome are the ones emptying your bank account today. The only difference is whether you see them in time. If this gave you a new perspective, subscribe. History holds the answers.